USA's 6% deficit risk urges business executives to protect long-term growth and build smarter fiscal strategy. You need to look closely at the United States right now because it is rapidly approaching a massive fiscal milestone as its public debt is projected to cross 100% of GDP this year. Imagine managing a business where you face persistent federal deficits of 5% to 6% of GDP year after year since 2022, especially when the broader economy is running at near full employment. You are looking at what Deutsche Bank Research Institute identifies as the single most concrete macroeconomic risk hitting the market today. If you think this is just a government accounting issue, you are missing the bigger picture because rising borrowing costs are actively swallowing a massive share of federal resources. You should be concerned that interest payments have officially overtaken defense spending as the absolute fastest growing component of the entire federal budget. As an investor or executive, your main challenge is no longer debating whether national debt matters, but figuring out how you can operate successfully while fiscal flexibility narrows. Impact Solutions points out that you cannot expect a $30 trillion nominal GDP economy to sail smoothly when its total federal debt has climbed well past $37 trillion. You are watching annual fiscal deficits continue to climb above $1.8 trillion, creating a massive headwind for long-term corporate planning. You might find it unusual that this debt acceleration keeps compounding even while unemployment stays historically low at around 4%. Traditional economic cycles usually mean deficits shrink when your economy expands, but what you are witnessing right now is completely different from past recoveries. You have to adapt to a reality where the federal funds rate remains substantially above pandemic levels, changing the basic math of public finance. With Treasury yields staying elevated across the curve, you are seeing the refinancing of existing debt become significantly more expensive than it was during the decade of near-zero rates. You are stuck in a compounding fiscal effect where larger debt balances meet higher financing costs, driving up annual expenses regardless of any new spending plans. Global investors still treat U.S. Treasury securities as a liquid safe haven asset, which keeps demand alive for you despite the expanding supply of debt issuance. If you want to allocate long-term capital effectively, you must now evaluate fiscal sustainability alongside labor productivity, innovation capacity, and monetary policy credibility. You should realize that true fiscal discipline has transformed into a major competitive economic advantage rather than just a boring political goal. Persistent deficits can quietly crowd out your private investments over time, putting continuous upward pressure on long-term interest rates. You will likely face reduced policy flexibility during future recessions, making it much harder for you to navigate multi-year capital investment decisions safely. While you still benefit from structural strengths like technological leadership and deep capital markets, keeping those advantages relies entirely on sound fiscal management. Impact Solutions reminds you that fiscal strength cannot depend on structural advantages alone when Washington continues to borrow $1.80 to $2 trillion annually. You will rarely see sovereign debt crises happen overnight because fiscal deterioration creeps up on you through compounding mathematics rather than sudden shocks. You need to track the hundreds of billions of dollars in Treasury requirements maturing each quarter that must roll over at interest rates higher than those in 2020 and 2021. Think about how a sustained 100 basis point increase in average borrowing costs can eventually force you to deal with over $300 billion in extra annual interest expenses. You should note that net interest payments now exceed the annual U.S. defense spending of roughly $900 billion, completely reordering public expenditure priorities. It might shock you that entitlement spending continues to consume more than 45% of total federal outlays, leaving very little room for growth initiatives. Every single time another $100 billion goes toward interest payments, you lose out on vital capital that could fund infrastructure modernization or cybersecurity. You lose federal backing for artificial intelligence research, semiconductor manufacturing, and workforce development initiatives that could have boosted your long-term economic returns. You must recognize as a corporate leader that sovereign fiscal pressure directly influences your private sector capital costs. Your borrowing benchmarks are being set by elevated Treasury yields that dictate terms across the $11 trillion investment-grade corporate bond market. You are feeling the squeeze because these yields also ripple through commercial banking assets exceeding $24 trillion and private credit markets valued over $2 trillion. When your benchmark yields stay elevated, you will face much higher financing costs for your everyday acquisitions and standard capital expenditure. You will find it tougher to fund commercial real estate projects, supply chain expansions, and critical technology investments under this interest rate regime. L-Impact Solutions highlights a glaring governance gap where your 5 to 10-year strategic plans conflict directly with short-term annual congressional appropriations. While you try to evaluate your long-term obligations over a 20 to 30-year horizon, federal budgeting operates through messy, unpredictable debt ceiling negotiations. You are forced to deal with policy uncertainty that severely complicates your capital planning as both a domestic and international provider of capital. If you want to preserve long-term economic leadership, you must advocate for reducing structural deficits before global financial markets demand higher risk premiums. You can look to a credible 5 to 10-year fiscal consolidation framework as the most effective path forward to stabilize the economy. Gradually dropping the federal deficit from 5% or 6% of GDP down to 2% or 3% over the medium term will protect your business from sudden austerity shocks. You will find that financial markets reward predictable, smooth fiscal adjustments far better than emergency measures introduced during a crisis. You should count on economic expansion as your primary tool, since every extra 1 percentage point of sustained real GDP growth generates hundreds of billions in revenue. You can see your tax revenues improve naturally without anyone lifting your nominal tax rates if productivity takes center stage. Your business can thrive by focusing on investments in artificial intelligence, advanced manufacturing, semiconductor production, and digital transformation. You will lift productivity growth well above its recent long-term average by deploying automation and logistics upgrades inside your operations. L-Impact Solutions strongly advises that government expenditure prioritize investments that carry measurable, high economic returns for your industry. You should target infrastructure projects because research shows well-targeted initiatives frequently generate economic multipliers exceeding 1.5 times the initial investment. Expanding investments in ports, broadband, and power grids directly strengthens your private sector expansion and daily operational capacity. You can benefit from sophisticated debt management if the U.S. Treasury extends average debt maturities across its $29 trillion market to limit volatility. You must prepare your corporate board for an environment where policy rates and long-term Treasury yields stay structurally higher than the 2009 to 2021 lows. You need to maintain much stronger liquidity buffers and keep your debt service coverage ratios safely above your lender's minimum requirements. By diversifying your funding sources and stress testing your capital models against 4% to 6% interest rate scenarios, you preserve massive strategic flexibility. If you are an institutional investor, you should strengthen your portfolio resilience by diversifying across duration, credit quality, and real assets. You must regularly evaluate inflation scenarios, Treasury issuance trends, and debt servicing costs alongside your traditional corporate valuation metrics. Establishing a legally binding medium-term fiscal framework that cuts deficits to 2% or 3% of GDP will restore your policy certainty for multi-year planning. You should monitor CBO projections warning that federal debt could hit 118% of GDP by 2035 and smash past 150% of GDP by 2055 if reforms stall. If you can help spark a 0.5 percentage point increase in annual productivity growth, you will help expand the national tax base organically. You cannot assume the US dollar's 58% share of global foreign exchange reserves and 88% share of forex transactions will permanently shield you from fiscal reality. Your board must integrate sovereign fiscal indicators into your enterprise risk management framework to survive sudden spikes in refinancing costs. L-Impact Solutions suggests you actively explore public-private partnerships to handle the massive multi-trillion-dollar infrastructure investments required over the coming decades. You will protect your profit margins and preserve long-term shareholder value only if you actively build sovereign debt trends into your capital allocation models. Ultimately, you will realize that disciplined fiscal governance is no longer just a budget goal, but the definitive competitive strategy that will dictate your capital flows for the next decade. Can your business outgrow a government running 6% deficits? Comment below. For more strategic analyses, visit our business consultancy website, link in the description below. Thank you.